Hi friends, welcome back to my channel after a long time. Today in this video we'll discuss about short duration debt fund and we'll compare it with fixed deposit returns. Friends, you must be aware that interest rates are increased significantly in past 6 months. Because of that, good return can be generated from the short duration fund. So let us start. Before going through the ultra short term fund, let us first understand the basic terms of debt fund. The first is modified duration. Modified duration of fund means average maturity period of all securities of the fund. Second is yield to maturity. Yield to maturity, that means YTM means average yield of all securities. If YTM of fund is 7% and modified duration is 1 year, that means you can expect 7% return per annum. Third is effect of change in interest rate. Let's presume that RBI announced the increase in interest rate by 1% from 7 to 8. Then to match the future rate of 8%, NAV will reduce by 1% on that day, but eventually during the period of 1 year, investor will get 7% return. So in summary, higher the modified duration, higher the effect of change in interest rate. In order to avoid the risk of mark-to-market change in interest rate, it is advisable to invest in those funds where modified duration of your fund is more or less equal to your time horizon of investment. Now let's discuss about ultra short term fund. Modified duration of ultra short term fund is usually about 90 to 135 days. That means if any change in interest rate, mark-to-market effect on NAV will be minimal and will be nil over a period of modified duration, that is 90 to 135 days. On screen, you can see the expected return of some ultra short term fund. Considering the expense ratio, you can reasonably expect return of 6.33% per annum. Let us now compare the expected return of FDR. On screen, you can see the expected rate of return of FDR of 90 days. You can easily compare the expected return of FDR with ultra short term fund. It is 6.33% as compared to 4.31% in FDR. The other most biggest advantage is flexibility of exit route. In FDR, you will lose the interest in case of pre-maturity, but in debt fund, you will get the redemption amount based on previous day NAV. So when you are not sure about the expected requirement of a fund in a specified period, it is always advisable to keep your investment in debt fund. On screen, you can see some low duration funds. Here the modified duration of the funds are almost 8 to 9 months. On screen, you can see the expected return of the funds. After deducting the expense ratio, return can be expected up to 6.5% per annum. Now let us compare it with bank FD for a period of 6 months. On screen, you can see the average return of 5.14% as compared to return of 6.5% per annum in low duration fund. Here also other advantage of flexibility of exit route. You can redeem the fund at any time and you will get redemption amount based on previous day NAV. Friends, I have observed that most of the people are not aware about advantage of debt mutual fund. They are worried about the paperwork, but you can use it online platform. It's very simple. Friends, please share your views which will help us to serve you in a better way. Thank you.